Yeah, so something the market wasn't impressed with, Stephen. I had a bit of a shoulder shrug too when I went through this. I thought this was Bloomsbury's report. Um, Back to prices not seen since kind of like this time last year, sort of thing. But yeah, I thought there is a bit of a difference between these full year results and the sort of update they gave us about them, and the market has kind of rightfully sort of punished them for that difference. So a sort of gentle reminder that this was a year where we didn't have a book release from Bloomsbury's biggest publisher, biggest author. Sorry, so this is going to be a steady year. Let's have a look. So revenue was up about 5%. So it went from 342.7 million to 361 million. PBT, so profit before taxation and highlighted items, decreased by about 14% to 42.1 million. It was 48.8 million. They said that this followed a period of high operational gearing on exceptional sales in the prior year, and that the profit was actually in line with the consensus expectation. Total dividend per share, that was about 5% on the year on year, up to 15.43 pence from 14.69. It's about a 31% increase since 2022. Net cash, Steve, was about 170 million, a decrease. A decrease of about 60. Net cash was at 17 million. Sorry, a decrease from 65.8 million, and this was obviously due to the acquisition in the middle of the year of Roman and Littlefield. They were keen to point out that cash conversion was very strong, Steve, at 156%. In terms of operational highlights, the consumer division was steady away, grew about 3% to sort of around 256 million. They said that success was kind of broad based across the portfolio. There was fantasy, romantasy, Steve, which is a word I didn't know existed, and I'm not sure should. Cozy crime, non-fiction lifestyle, and cookery. They were keen to point out that they did win Publisher of the Year this year at the British Book Awards, and Gillian Anderson's book, which name escapes me, but they publish it, that also won a quite significant award. In terms of non-consumer, and this is kind of academic, sort of professional publishing and special interest, the revenue there grew by about 12% overall. If you split it down into sort of academic and professional revenue, it was actually up 18% to about 83.3 million. Now, 19.8 of that revenue was from this new acquisition. So actually, organic revenue in that segment dropped by about 10%. And they said that this was basically budgetary pressures and an accelerated shift from print to digital. Steve, you'll probably be able to tell us more about that, or if that's a real thing. Bloomsbury Digital Resources, they said that revenue there grew about 2% to 27 million. They were ambitious about this digital resources business, and they think that by 27 to 28, they'll have about 41 million in revenue, so nearly 50% on top of that to come in the next couple of years. So in the strategic developments, they were still talking about this Bloomsbury 2030 vision. Essentially, it's a vision focused on growing the business, growing the portfolio, and growing the people at Bloomsbury. And they're making significant progress on that. There's a whole lot of spiel on that, but it's kind of like reading ESG to me, Steve. They talked a little bit about the Roman and Littlefield acquisition. They think it's really strengthened their academic and digital presence in North America, and they think that it's integrating itself really, really well. Obviously, back in August 2024, we reported on at the time that they got into the FTSE 250, and also later this year they'll be opening an office in Singapore to capitalise on growing student populations in Asia and building on the successes of their arms that they've got in India and in Australia at the moment as well. They did talk about AI because it would be wrong of them not to, Steve. They said that they're progressing with opportunities to monetize academic content through AI deals in authors' best interests and have hired a head of AI innovation. Essentially, what they're saying here is that they're going to try and sell academic content through these AI chatbots and try and get some kind of revenue from it. I think I mean, if you've ever tried it, the more recent ones, I think they've kind of got that content. So you're not gonna lie to you. I think it's kind of one of those. It's only fair to pay for it kind of thing. So we'll see where they get with that, but interesting nonetheless. Um, they talked about diversification strategy, portfolio strategy kind of thing, combining consumer, academic, sort of digital and print publishing. They think that it's a fairly resilient business and it generates strong cash. I don't really have any arguments with that point of view. A couple of changes at the top. Penny Scott Bayfield, she's stepping down to pursue a portfolio career, which Steve and I had to Google what that was. It basically means she wants 10 jobs instead of one. And Dame Heather Rabbits, which we did talk about at the time, she is a non-exec director that came in April. In terms of guidance, they said broadly in line with current consensus expectations, and so long as we get a constant currency. They said that they're confident in this resilience created by this strategy that they've created, and they think it's underpinned by also authors, customers, consistent track record of performance, and the business scale. There were some other highlights, Steve, which I won't get into, but it's a load of books that are coming out. Really, there is a Sarah J. Maas book on the list, but it's a paperback version of a hardback that's already out. So yes, it doesn't look like we're getting Sarah J. Maas this year. So it might be another year of steady away, which is fine by me, Steve, because I am in kind of like acquiring kind of mode with Bloomsbury, and if the market wants to whack 19% off it today, I think these are kind of not even dark clouds, Steve. I think these are just kind of like murky, bubbly water that you can just kind of push out the way, and see the good stuff that's going to come, Steve.
If you think the reason the stock has gone down quite a bit on this report is because, largely speaking, boils down to there wasn't a Sarah J. Maas book this year and the consequences of that. This is an easy buying opportunity, you would think. I mean, there's cyclical businesses where you sort of think it's kind of hard sometimes to work out where you are in the cycle because, hey, maybe you're in a super cycle and stuff's going to barge higher, or maybe it's suddenly going to drop off a cliff and maybe it can go lower, so it's hard to know where the dip is. But this is kind of pretty much forecasted for you in this situation. If you think, is there a Sarah J. Maas book? No. When's the next one coming? It's not like it's a recession where they sort of sneak up on people. These are pretty well telegraphed ahead, one way or another, and that's in that way sort of surprising to me if that's what this kind of comes down to. The thing now trades at an 11 PE or so, and that's pre-tax profits down 14%. This doesn't to me seem like a particularly warranted discount if you think, look, it was just a quiet year for publishing and for big level publishing anyway. Gillian Anderson's book, I think, is called Want with a T, not a K, but it's about that kind of. That's the general vibe of the book, from what I can make of it anyway. I haven't got around to reading it yet, or indeed looking at it, or whatever you're meant to do with that book. But you talked about the kind of shift to digital in the online stuff. It reminds me of a conversation I was having with another friend of mine who's an academic. She's not certainly my colleague. But one of the issues that academic publishers have or claim to have, this is mostly in the books bit rather than in the journals bit, is stuff like, basically called LibGen or various Russian online things that post PDFs of academic books. And academics appear to be, they can't work out what they think of it, I think is the honest truth. I can tell you what I think, and I'm an academic as much as anyone is, and as I don't care. I would rather the thing was made available to more people and they were able to read it rather than, in this case, Routledge, which I think is part of Taylor and Francis, which I think may now be part of Bloomsbury, is kind of part of is making a load of money off it. I'd much rather it was available for people to read and I never make any royalties off it whatsoever. There was a recent thing where it was found that Meta's chatbot, and I imagine others are doing it, as you pointed out along the way, had been scraping from these areas. In other words, basically mining a load of academic content for free. And some of my friends got kind of up in arms about this. They don't object to their stuff being on LibGen for free, but they object to the Meta chatbot mining it like that. And I didn't really understand what I think the difference there is, other than Meta is big, and Meta is potentially morally objectionable for any number of reasons anyway. But there was, that kind of moved people to action. So I'm sort of a bit wary about that. Shift to digital in general, I think, is kind of largely happening and not likely to reverse one way or another here. So I thought, overall, stock has gone back by about a year after a very good year. So that is quite a significant step backwards. This year has been a lot quieter than the previous one, but yeah, I mean, to finish where you finished here, Steve, of barely even dark clouds that you can see through, this just looks to me like a sort of predictable downish, predictable quieter year, and you're not really even trying to kind of gauge this from an end market particularly. It's not like you're trying to say, look, I imagine this recession's ending soon, demand will pick up. Demand is basically still there. You're just kind of slightly supply constrained by Sarah J. Maas's ability to write books at speed, or desire to write books at speed, I suppose.
Exactly that, Steve. I think that's the kind of point now. Sometimes with stocks, you have to sit and wait on them. So Bloomsbury's been a decent winner for me, and I'm happy to sit and wait and collect the dividend while it kind of accumulates. And Sarah gets rating. One of the books I did see on the list, Steve, and I just had to. I didn't realise the other books that had come out were Bloomsbury books, but I double checked and they are. Is Rutger Bregman's new book, Moral Ambition. I don't know if you've read any Rutger Bregman before. Humankind and Utopia for realists. Now, I seem to remember Humankind came out and I read it and it was fascinating. Some of the stats and information that he's managed to read. And then the Ukraine and Russia war happened. And when you read Humankind, with the context of what you were seeing at the beginning when the Russia and Ukraine coverage was very heavy, was a lot of that book. Well, it either doesn't include the Eastern European mindset or is a little bit hubristic in places. But very much enjoyed the book, very much enjoyed Utopia for realists as well. So that's definitely one that'll be on my list of things to read. Yes, and we're definitely much higher than Paul Hollywood's Celebrate Joyful Baking All Year Round and Tom Kerridge's The Barbecue book. But yes, there's a new Harry Potter as well, Steve. Would you believe they're still wringing that flannel dry? It's like the meme of I don't know if you remember when Obama was in charge and he was milking the dead cow. But it's called Harry Potter and it's a series of pocket potters. With 3 titles: Harry Potter, Ron Weasley, and Hermione Granger. So I'm sure that'll be making its way into various people's houses. But yes, I agree with your points overall, Steve. I think, not even dark clouds you can see through. It's just clouds, and I can see through them to a rosier time. And it's a shame, really, that the market is so bad at being forward thinking, but it's priced in a pretty crappy report, which is what Bloomsbury have put out, because that's the year they've had and probably the year they'll have next year. But for people like us who are prepared to wait, Steve, obviously time is our best ally. As investors, it's the only thing that we have an advantage over the big hedge funds with. I'm happy to buy and wait.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.